welcome to Money, Me and COVID-19, where we talk to experts in the world of finance and property to find out what is going to be the impact of this unprecedented virus and the way in which governments are reacting to it. How is it going to affect our daily lives over the coming weeks, months and years? My guest today is the well-known Money Week writer, author and value investment fund manager, Tim Price. Tim, welcome to the show.
Thanks very much, Graham. Pleasure to be here.
Now, I said that Tim's a value investor. That even applies to his IT equipment. So please do not adjust your set. There's not a problem with the webcam on Tim's computer. It's just that he went to the bargain basement in Aldi and he got the only computer in the country that doesn't have a webcam. So he's joining us in audio only, but it's great to hear from you anyway, Tim.
Thanks, Graham.
Now, let me go straight in with the $64 trillion question, Tim. What on earth is going on? What do you make of the way governments are reacting to COVID-19? What is that doing to the markets? And how are us poor investors supposed to respond?
These are all excellent questions, and I'm not sure I have the answer any more than anybody else does. What's abundantly clear is that governments are not responding to this in a unified way. There seems to be no real coordination of effort going on. So everyone's coming into this crisis pretty much from a blank sheet of paper. Some governments seem to have been better prepared, the likes of South Korea, Singapore, Japan. Other governments seem to have been, without pointing fingers, seem to have been sort of rather slow to wake up to the reality. But at the end of the day, it's like that old Irish joke that becomes increasingly less funny over time, which is the guy asks for directions and the person who answers says, well, I wouldn't start from here, but we're all sadly starting from here. In terms of the market situation, this is so fast evolving. I think it's difficult to make any hard and fast conclusions. What I would advise any investor is to sort of firstly take a sort of calm assessment. The job of markets is to look forward into the future, try and price in what hasn't actually yet happened. And obviously the violent swings that we're seeing in stock markets suggest that the market simply hasn't got a clue what's going on. So I would try and sort of take a step back, look at things from 30,000 feet and splitting things up into, let's say, asset class types. I think the critical thing will be, firstly, I think this is an issue of capital preservation and survival first and foremost. Then we can worry about where we're going to make profits in the future. So I think the first thing is to kind of triage your portfolio and see where the risk lies. So for me, at an asset class level, the risk undoubtedly lies in bonds, in fixed income instruments, in government debt, corporate debt, and then everything else is secondary, because it's quite clear that firstly, the big state is back. The big state is back with a vengeance, and that has monetary and fiscal implications. I'm just seeing if I can find it. There's a quote that Mario Draghi wrote a piece for the FT, Financial Times, last week. And I'm just going to read out one paragraph from that piece, if you'll bear with me. The challenge we face is, said the former head of the ECB, the European Central Bank, the challenge we face is how to act with sufficient strength and speed to prevent the recession from morphing into a prolonged depression, made deeper by a plethora of defaults, leaving irreversible damage. It is already clear that the answer must involve a significant increase in public debt. The loss of income incurred by the private sector and any debt raised to fill the gap must eventually be absorbed wholly or in part onto government balance sheets. And then this is the killer punchline. Much higher public debt levels will become a permanent feature of our economies and will be accompanied by private debt cancellation. Wow.
Yeah, and do you want to just explain what actually private debt cancellation means?
Yeah, so I think what Mario Draghi is getting at there is, firstly, when he talks about much higher public debt levels, he means that the amount of government debt, sovereign debt in the system is going to go even higher than it already was, and it was already egregious and unacceptably high. When he talks about private debt cancellation, I think he's basically talking about corporate debt being defaulted, what's the phrase, a jubileed, just being forgiven. But basically what that means is if you're a holder of that private debt, your portfolio just got vaporized.
Exactly, and one of the things that concerns me is if you speak to a high street financial advisor, they would say oh, the stock markets are looking a bit dodgy, let's do a flight to safety and we'll all go into government bonds. And that's the very thing you're saying could be the highest risk asset class.
Yeah, I think so. I mean, we've been concerned about debt levels for a while. We were concerned about debt levels coming into the global financial crisis that's now 12 years ago. Amazing to recount. So we were worried about debt then. If we were worried about debt then, we have to be much more worried about it now, because, you know, at the end of the day, debt's all very well if you're the borrower, but it's kind of catastrophic if you're the investor, and then you start seeing words like debt cancellation being bandied about, with abandon by people who are, you know, at the epicenter of this financial sector.
But also, I suppose, if you, let's say you choose to avoid corporate debt that you feel might be higher risk, but you then go into government treasuries and so on, they're now looking like most of them are going to be kind of zero or negative returns. So even that's a guaranteed loss.
And not only that, I mean, that's correct, but not only that, it's worse than that, to the extent that if, I mean, again, I say it's kind of too early to make some of these conclusions because things are moving so quickly, but it is entirely plausible that in line with this huge increase in government debt, we're also going to potentially see in the near to medium term an outbreak of either messily high inflation, given the amount of money that's being printed, and there's going to be nothing on the other side to offset it in the way of, say, tax revenues, because so many people and businesses are going to go under as a result of this. So on the one hand, you've got the debt load getting higher, and on the other hand, you've got potentially high inflation or stagflation, that old keyword from the 70s, if anyone remembers that. Either way, you know, debt as an asset class has never been this expensive in 5,000 years of history. That would suggest to me that it's probably best avoided, if at all possible, if you have the choice to
The other
avoid
side, obviously, I think most of the stock markets, we've seen like a 30% drop. We've seen a little bit of a boom when the massive $1 trillion recovery schemes are announced. But some people seem to think they're being smart at getting in now and, you know, buying these reduced price assets. What's your view on how close we are to the bottom of the stock market?
It seems to me that trying to pick a bottom in the stock markets generally now is a bit like trying to catch a falling safe. So from a technical perspective, it probably is best not to buy until you've had confirmation that we've hit bottom and that bottom has been tested and found robust. So I don't think we're there yet, but I don't know, I may be wrong. What I'd also add is not all markets are created equal going into this crisis. So for the sake of argument, just to use an example, Japan, which has long been our favorite market geographically, as a region, Japanese companies have been hoarding cash for the last 25 years because they've been dealing with their own domestic deflationary depression. As a result, Japanese companies by and large now have the healthiest balance sheets in the world. They've also tripled their dividends over the last 6 years, and they are, for want of a better phrase, those companies that have little or no debt are pretty bulletproof. By comparison, say, to ... you know, Big Finish, the US. So US companies are coming into this crisis with more debt than they've ever had on their balance sheets, with the valuations of their listed equity fueled by lots of years of easy share buybacks, which have benefited the management but not necessarily anybody else. And as a result, they look very, very vulnerable to me. So we're not a hedge fund, but if we were a hedge fund, we'd probably be long Japan and short US, for example.
Okay, and one of the things I know obviously markets are meant to do is kind of price discovery. And if you look at that, just imagine a scenario where I own a big brand chain of hotels. I long ago did a sort of sale and lease back. So I no longer own the bricks and mortar, I just kind of operate them. They're now all closed. You know, what is a fair share price for my company in this scenario?
It's a very good question. I don't have the answer to that.
Yeah, so to me,
Potentially it's nothing. It's zero.
Yeah, exactly. Logically, it's zero. So
the way I'd look at the market, you know, in writ large is, you know, I mentioned triage earlier. I think it's a bit simplistic, but it's perhaps legitimate to say, well, there's going to be three types of businesses that you might be looking to invest in, or for that matter, steer clear of. The green sector, if you like, are those businesses that actually stand to benefit from this crisis, and I think there probably aren't that many of them. But they might include certain pharmaceutical companies, certain businesses that are catering to the rise in remote working, which now looks like it's going to be accelerated, you know, to the power of 10 by this mess. Then you've got the amber companies which are going to be impaired inevitably by the slowdown, by the lockdown, but they'll come through the other side, hopefully. And then you've got the red companies, and the red companies aren't going to make it. Or if they are going to make it, they'll only make it through extraordinary governmental support, which I would frankly be loath to see, because we had enough of that mess 12 years ago.
Oh yeah, we still have zombie companies from there.
Yeah.
So if we go through the asset classes, I think it's clear that shares are quite shaky. You have to be very selective. Bonds, obviously, you've made it clear what you think of those. What do you think the impact on the property market will be from all of this?
I think it'll vary by region, because obviously, it's that old argument about valuation. About what do they call it? Location. So clearly, not everyone will be entering this crisis in the same position. But ultimately, property is a bond-like asset, and then you're getting into the realm of basically what future behaviour is going to be like. It's probably too early to say, but I suspect that the one impact from this global pandemic will be that the business attitudes change, that people's attitudes change. For example, I noticed that WeWork, which is one of the more sort of the poster children of sort of insane .com level, corporate insanity and access to cheap capital and all the rest, is sort of an outsourced office provider. I'm not convinced that. I'm convinced that remote working, i.e. people working from home, is likely to accelerate. I'm not convinced that people are going to want to spend, let's say, more time in offices as and when the dust settles. So some types of businesses may just go away and never come back.
Well, let's talk about another sector, another asset class I know is close to your heart, and that's this stuff, the yellow metal. What do you think the impact on the gold price of all this is going to be?
I sense that, I'm coming from the backdrop of an acknowledged oversupply of debt that's been building for years. If you accept the thesis that we've had too much debt for years, but there's going to be even more of it now issued per what Mario Draghi was writing about, I cited earlier. If you accept the thesis that the debt load is already gigantic, then you have to look at what's going to be the route out of this predicament. So one route out is that governments around the world are able to engineer enough economic growth to keep that debt serviced. I think that was impossible before, and I think it's doubly impossible now. The second option is that you default on it. We also operate in a credit-based economy. So widespread default is the economic equivalent of Armageddon. So let's park option 2. What is in box number 3? What is in box number 3 is what every heavily indebted government has always reverted to over time throughout all recorded history, and that's inflated away, inflation. So if you buy into that thesis, then the one asset that you probably want to own over any other is gold. Why? Because it's a form of money. It's always been money. It's a form of money that can't be printed. As simple as that.
Okay, so are you increasing your own holding of gold at the moment?
Well, I already own so much I can barely walk in a straight line. But what we've been doing, for example, within our fund is we've been rotating out of industrial cyclical stocks that we already liked anyway, but they've clearly been whacked by the sort of the downdraft, the generalized downdraft. But we've rotated those holdings into basically precious metals miners, predominantly in Australia, that have little or no debt. Because our thesis would be firstly that the gold price does go higher, but let's assume it just stays where it is. These companies which have little or no debt already have great margins. Those margins, if the gold price rises, will get even more attractive. So although, as I say, all markets are not created equal, I think there are pockets of opportunity within the markets if you look hard enough.
Okay, so you have had to make some changes, because in a sense, as a value investor, you've had a challenging few years whilst all the money's been piling into these tech stocks.
Sure.
Has the jour de gloire finally arrivé for value investing, Tim?
I'd answer it a different way. I think that the growth story and the passive investment story are now fighting their Waterloo, because you've had years and years of easy money basically by dint of a bull market. So investors made easy money, or what looks with hindsight to have been easy money, by buying cheap funds, market trackers, et cetera, et cetera. I think that story, that narrative, that whole narrative is probably going to change. I think investors may finally belatedly wake up to the value in being a bit more discerning. Because let's say you're tracking the S&P 500 in the States, or the FTSE 100 here, or whichever your index. That index is going to contain good, bad, and indifferent stocks, but some of those stocks are going to go to zero. I think as a result of this crisis, it's, you only have to look at the US jobless figures, and having sort of tootled around for whatever few 100,000, they've suddenly shot up to 6.6 million. The chart, it's like, I saw a tweet earlier from someone who just said they chose that iconic scene from Jaws, and the caption was, "We're going to need a bigger y-axis."
Yeah, so and I think the trouble is, when you talk to sort of market analysts and forecasters, they tend to heavily lean towards, tomorrow is going to be like more of today.
No, I don't think that works now. I think, sorry to interrupt. I think that's the danger, that people revert to, well, this has always worked in the past. So it's a brave new world now.
It is, and smarter people than me seem to be suggesting that it's highly unlikely that the next 10 years in, for example, the stock market can possibly produce anything like the returns we've experienced in the last 10 years.
No, I absolutely agree. I don't see how they can, at least in terms of the trend. So for the last 10 years, you only, to make good money in the stock market, you really only needed to make one decision. And that decision was to own the US over everything else. The second decision was then actually not even to own the US, it was just to own the shares of Facebook, Amazon, Apple, Netflix, Microsoft, and Google. And there you are. So you're like 6 or 7 stock portfolio, beat just about everything else on the planet. That's not just to denigrate those companies, and some of those I'm sure will continue to do extremely well, but it just goes to show what a bifurcated market environment we've lived through over the last decade. So basically, you didn't need international diversification, you just needed to own the US, and you didn't need to own the US market in entirety, you just needed to own half a dozen stocks. I don't think that story is going to play out in the same way over the next 10 years.
Okay, well, just moving on to the other impacts of COVID-19. Obviously, you run your investment fund. Have you had to make any changes in how you operate your business as a result of all the lockdown measures?
No, not really. I mean, I've been working remotely for the last several years anyway. So we meet, we have an office in Hatton Garden, for example, and we meet there to meet clients. But that aside, I've been working remotely from home, albeit without a webcam, I'm afraid, for some time. My colleagues have now also started working remotely because the office is effectively in lockdown too. So the beauty, I mean, I hate to be sort of whistling past a graveyard, but the beauty of for example, an asset management business, a private client wealth management business, is that it can all be done remotely. Apart from the client meetings, and client meetings in future, I dare say, will be done over Zoom or Skype or equivalent services. This is why I say I think things really will have the potential to change quite quickly. A face-to-face meeting is desirable, but it's not essential.
Now, finally, Tim, the one area that I somewhat concerns me more than I think many people with these kind of scenarios is the impact on government increases in power and restrictions on our liberty, which never quite seem to get ratcheted back after the crisis. Witness the Patriot Act still on the statute book in America 20 years after 9/11. Do you have any concerns about big government and yet more permanent restrictions on our freedom?
Absolutely. I mean, I think I think a number of things are likely to change as a result of this crisis. One of the things I hope changes is the role of the media. I would say the mainstream media has done an appalling job of covering this, particularly in the UK. So I'm tired beyond measure of seeing hapless journalists just sort of launching gotcha questions at ministers who are frankly doing the best they can under extremely difficult circumstances. But in terms of how things are going to change, I don't think we can even begin to speculate about how things might play out in the fullness of time. One thing I absolutely hope happens is that there is some way of peacefully affecting change in the epicenter and source of this crisis, which is China. So I have no problem with the people of China, but I have a big problem with the Chinese Communist Party, which suppresses information and then lied about it. And as a result, tens of thousands of people have died prematurely as a result.
No, absolutely, and although obviously Boris jokes about an Englishman's right to have a beer in the pub, but the reality is we're kind of almost under martial law and house arrest at the moment, so it's unprecedented. Yeah,
we've never. I don't think even in the Second World War we've had this kind of such a dramatic, such a sudden and so severe sort of curtailment of rights. That the most moving thing I've seen recently was, I don't know that many politicians, but the one MP that I have met personally once or twice is Steve Baker, who's the MP for Wickham. And if you want to see something deeply moving, you just need to go onto YouTube and see the footage of him sort of rather reluctantly agreeing to support these draconian measures in Parliament. And he has tears in his eyes. It's very, 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 very moving.
Okay, well, so finally, to summarize, the sort of Tim Price view of the world at the moment, if I was to say sell bonds, buy gold, would that be a fair summary?
Yeah, I think that would be fair. So, we split the world up basically into three asset types. So we split the world up into value stocks, effectively defensive listed businesses that you're paying no great premium, or ideally you're buying at a discount to own, run by principled shareholder-friendly managers with a commitment to, with a real ability at capital allocation. So that's a portion. We invest in uncorrelated assets. So that's, for us, that's systematic trend following funds that have the capacity to make money in falling markets, which most traditional funds can't. And then the third component, and probably our highest conviction call at the moment, given the current and anticipated both monetary and fiscal stimulus, is real assets, notably the precious metals, gold and silver and related mining concerns, which have little or no debt. So that sort of range of three assets is what we've always invested in and what we'll continue to invest in.
Fantastic. Well, that's great advice to end on. Tim Price, thanks very much for joining us.
Thanks, Graham.
Join us again next time for another Money, Me, and COVID-19. Thanks very much for watching.